Hey, what's happening, guys? Dan Darrow here with another Options and Play video update. One of the things that I feel like is really important when you're sitting in swing trades, maybe a few weeks, a couple months, is this idea of constantly evolving targets and or stops, right? Because levels, price points, right, that were probably relevant and may have factored into your thesis when you first got involved over like the course of a few days, a few weeks. I mean, those are going to change, right? Because support, resistance, going to be constantly changing. And if you use moving averages, which I do and which a lot of the trades revolve around, then the moving averages, they're constantly moving, right? They're constantly dropping, rallying, or moving up, moving down. So you're going to get different levels at different times. And as you sit in that trade and let that trade develop, you need to adjust your targets and your stops accordingly. Okay. So Caterpillar was one that was on watch for a breakdown after earnings, right? So the stock had been in a pretty steady downtrend. Obviously, the 200-day, which is the yellow line, has been significant. And when it went into earnings, it had just ticked above the 20-day, which is the pink line, only to quickly drop when traders really didn't like the print, right? So in the aftermath of the earnings report, it looked like it was set up for a breakdown. It was not recovering. It kept failing at the 20-day, and it was leaning on the key 200-day on the downside, seemingly setting up a break lower, right? So you have had no follow through on the downside. At the same point, or at the same time, it also wasn't breaking out, right? Because the 20-day kept steadily walking down. That was resistance. It couldn't trade above it. The 200-day kept steadily walking up, couldn't break below it, right? So you had this increasingly tight pennant pattern that was forming. And even though the thesis was bearish, you have to realize that with the 20-day being the significant level on the upside, the stop kept getting lower and lower and lower, right? So where it initially started off of like around like 211, this week that stop had dropped to like 209, right? So instead of waiting maybe for like 211, 211.50 to hit, right? Because that was the original level. The 20-day was originally out of 211. Now, a week later, the 20-day is the key exit, and it's at 209 and change. So if you adjust your stops as the trade evolves, then that could save you, in this case, about 2 points, right? Because if you got out when it broke the 20-day, right when it started to cross above 209, 209.50, it would have saved you a few dollars versus waiting for it to get above 211, which was the previous level, right? And that's just recognizing that what's important to this trade and the thesis for this trade was the 20-day as a stop. And when the 20-day started moving lower, you need to adjust your stops to accommodate that. Okay. So just something that was on the top of my mind as we kind of get through earnings season, and a lot of more of the trade ideas are going to be more swing based. These are things you just really want to take into account when you're opening up a bunch of new swing trades. Is like if you're in them for a few days, a few weeks, you should at least once a day be circling around to them, seeing like, are the levels still important? Are the levels that I initially thought still relevant? Are those the key ones now, or do I need to like maybe adjust my target, or do I need to adjust my stop higher or lower? Okay, so just food for thought. All right, so if you like this video and you're looking for more information about swing trading with options, please follow up with the link in the description of the video for more information on options and play. Have a wonderful night. Stay well, and I will talk to you all tomorrow.